Hello ladies and gentlemen, welcome back to C.A.R. Entertainment. I'm your host Dylan Hamilton, and today guys we are going to be talking about A21 business studies, and this time it's going to be sources of finance. Our previous videos about A21 business studies and our other subjects as well have been pretty short, but sources of finance is a longer topic. There's a good bit to go through. Most of it's just repetition from what you would have done last year in AS. So if you can remember it from AS or even a GCSE, because it's pretty similar to GCSE as well, to be honest. Sources of finance. If you can remember that, you don't really need to watch the video, but it might be good for you just to keep watching, just because it'll give that reminder as well, and we'll be using graphical formats, etc. So let's just get straight into it. So what is the purpose of finance? Well, a business needs different sources because they'll have different implications, and therefore you must choose the most appropriate method to finance your business. The types of finance are usually based on the amount of money that you require, how quickly you need the money, what's the cheapest option available, the amount of risk that's actually going to be involved in the reason you need for your cash, such as expansion to an abroad country, or the length of time you actually need the finance for. So we'll go through the internal sources of finance first, which is finance that doesn't increase the debts of the business, and these include things like retained profits, personal savings, the sale of unwanted assets, and sale and leaseback. Then you have external sources of finance, which is finance that is provided by the people and institutions that are outside the business, and these do create debt that requires payment back. These include loans, overdrafts, shares, and debentures. So let's go through short-term finance, medium-term, and then long-term finance. The first form of short-term finance is an overdraft. So let's just say, what is short-term finance? For a start, just basic understanding. It's the short-term finance is needed by a business for the day-to-day running. It's usually up to the period of 3 years whenever you take it out. So an overdraft, an example, and this is when the bank allows a business to draw more money from their bank account than they actually have on it, so they're going to negative figures for a while. The advantages of this is that it's quick to arrange and you only pay the interest on the amount you've overdrawn, and it's a good solution to cash flow usually. But the disadvantage is that it's only suitable for a small amount. You have to repay it in a very short time, and the interest rate is still there. You can also get a short-term loan, which is when money is borrowed from the bank and you have to repay it with interest in 3 years, and you can use this to buy equipment, but a short-term loan is also not a safety net. Keep that in mind. The advantage is that it is easy and quick to set up. Small or large amounts can be borrowed, and it has a structured repayment term, but you do have to pay an interest rate, of course, and you can have a poor credit rating or bankruptcy if you do not keep these payments up. So trade credit and security then. Well, trade credit is when items are bought from a supplier on a buy now pay later basis. So you get the product and you just pay them later essentially. The advantages is that you have more cash in the immediate future with no interest. You don't pay interest. The disadvantage is always that it's only available on certain goods and you have to sort of pay it within 30, 60 or 90 days. Security is something that acts as an insurance to a lender that it will get its money back if the business were unable to pay the money back. So this lends itself to trade credit as if you buy a product but you haven't paid them, you say they'll pay them back later. If you don't pay them back, that company has a legal right to come and take something from you, such as an asset like a car or a vehicle, something like that. So medium-term finance is finance taken over the period of 3 to 10 years, and its purpose is to replace expensive equipment. You can expand or you can convert your overdraft to a loan with this as well. So start off by going through fixed and variable rates, because this is what's going to come under loans and stuff like that there, and mortgages and stuff in the future. So a variable rate is an interest that varies with the Bank of England in regard to interest rates, and a fixed rate is an interest that is fixed for the duration of the loan. Now there are advantages and disadvantages, such as a fixed rate advantage is that you're going to know your payment cost. It's never ever going to change. But the disadvantage of this is that if the rate falls actually lower, you're still having to pay a higher rate. Although you do get an easier financial by planning out having a fixed rate, because you do know exactly what you're going to get. The variable rate has an advantage, as if the rate falls, then you will actually pay that lower rate. You're not going to have to pay the higher rate like the fixed rate. You will accordingly know with the rate. You will be paying the rate that it is. So if it goes lower, you'll be spending less. But the disadvantage is that you don't know your repayment cost, so it's very hard to plan your financial situation. So leasing is another form of medium-term finance where you will pay installments over a set period of time, but you will never own the asset even once you've paid it off. The advantages of this is that you spread your payment over time, and this leads to improved cash flow, and the leasing company is also responsible for maintenance. The disadvantage is that there is quite a high interest on this and you never actually own the asset. The opposite then is hire purchase, where you pay for the item in installments over time, but you own the item after your last payment. So your advantages, again, you spread the payment over time, you have improved cash flow, but you actually own the item. And the disadvantage is high interest. The only way I look at it is that hire purchase is the exact same disadvantage as leasing, only you take the fact they don't own the item and the disadvantage, you turn that into an advantage and just say they own the item. Otherwise, it's the exact same. So long-term financing, which is finance that is in excess of 10 years, and the first one here we're going to talk about is the issue of shares, which only PLCs or LTDs can use, more so than a PLC, to be honest. So the issue of shares is shares that are sold to an individual and a shareholder which are entitled to a dividend, again only available to an LTD or a PLC. The advantages is that you don't pay back the money that's actually invested. So if they invest £2,000, you don't pay them back £2,000, you pay them back whatever percentage it is they own in your company, and then that's what percentage of profits they get back. So it's cheaper than a loan, and it can also raise a very large sum of money. The disadvantage though is that you do pay dividends, and over time you may actually pay them back more than what they invested, but usually shareholders will then reinvest as well. So you can also lose control of shareholders, because obviously they get a decision making in the company because they're part owner, and investment can be lost if the business fails as well. Sale and leaseback is another method where you will sell the asset and then lease it back. So if I have a vehicle, a van, I can sell that but say, right, I'm going to lease that back from you. So I'm never going to own the asset back, but I'm still going to be able to use it and just pay it off over time. But I sold it to you first. So essentially you're just evening yourself out. The advantages is that you can still operate as normal after the sale, and the leasing company will be responsible for maintenance. So you've sold the assets, you get all that cash immediately. So you might sell the van for 10 grand, you get that 10 grand in your account immediately, and then you might lease it for 12 grand over the pace, or over the span of, I don't know, 5, 6, 7 years or whatever. I don't know, maybe more if it's a larger vehicle, and essentially that allows you to budget better. So over that amount of time you're spending very little amount of money, which gives you time to bring in a large amount of capital. So therefore that 12 grand is really inefficient. Although you've technically lost 2 grand, the fact is you're trying to make a large amount of money by still being able to do that. The disadvantage though is that there's a high interest, there's no longer own the item, which is obviously not great, and there's no guarantee the lease is actually going to be renewed. You then have retained profit, which is an obvious one, which is when profit is retained for use in the future. The advantages is that there's no need for you to pay interest, and the disadvantage is that you can invest it elsewhere. You may not have enough retained profit, and shareholders will be unhappy because they're going to get a lower dividend, of course. Thanks for watching this video. I've been Dylan Hamilton from C.A.R Entertainment, and I'll see you next time.